students, welcome to the video on financial accounting at your fingertips. In this video, we are discussing reconstitution of partnership part. Already, we have taken 11 videos. This is the 12th video on which we want to solve one problem relating to both admission and retirement of partner. In the given problem, X and Y are equal partners. X by agreement retires. Z joins the firm. So retired partner is X and new partner is Z. On the basis of 1/3 share, Z will get 1/3 share, so that Y will get 2/3 share. On 1st April 2022, the balance of the book as of 31st March 2022, that is the balance sheet there. Asset, goodwill 1 lakh, fixed asset at cost 12 lakh, current asset stock 6 lakh, debtor 4 lakh, bank balance 80,000. Total comes to 23 lakh 80,000. On the liability side, creditor 2 lakh, provision for depreciation 1 lakh 20,000, X capital account 10 lakh 40,000, Y capital account 10 lakh 20,000. Total comes to 23 lakh 80,000. Goodwill and fixed asset valued at 3 lakh and fixed asset 14 lakh, that is respectively. It was agreed to retain off accordingly before admission of Z. Before the admission of Z, goodwill account to be retained off. Here goodwill is shown on the asset side as 1 lakh, so it is debit balance. We have to write down the goodwill. So first term entry will be there X and Y are equal partners. So X capital account debited, Y's capital account debited 50,000, 50,000 to goodwill. So first journal entry will start. Journal entries. So first is particulars, debit, credit. So this is particulars. That is ledger folio LF, then debit amount, credit amount. This is the page on which it is written, that is ledger folio. So first journality is X capital account debited, Y's capital account debited, because they are equal partners, so 1:1, so it is 50,000, 50,000. So debit amount is 50,000, here 50,000. To goodwill account. Goodwill is debit balance, it will be closed by transferring to credit side. To goodwill account, that is 1 lakh. Being goodwill written off. Goodwill in the books of existing firm written off. Goodwill written off first. Written off on retirement of partner. This is first. Then second, there will be re-evaluation, that means sufficient money to be introduced so as to enable X to be paid off. So X is retiring, so Y and Z must introduce sufficient money so that X will be paid off. And the balance in cash at bank balance should be 50,000. That is, cash at bank should be 50,000. Y and Z are to provide such sum and to make their capital proportional to their share of profit. So we have to calculate the adjusted capital of Y and Z. So assume that agreement was carried out. Assume that the agreement was carried out. So the journal entry required and prepare revaluation account, capital account, balance sheets after admission of Z. So revaluation here fixed asset valued at 14 lakh. So it was 12 lakh book value, now 2 lakh increase. Increase in assets should be debited. So we will debit fixed assets account. Fixed assets account debited. So amount is, that is 2 lakhs. Then another provision for debtors, depreciation. Provision for depreciation, it is against asset. So it is credit balance. It is not needed. So it will be adjusted, debited. So debit provision for depreciation, debited. So amount is 1,20,000. To revaluation account. Revaluation account. So it is given to do to prepare the revaluation account. So we will prepare only revaluation account like this. Revaluation account. This is debit, this is credit. So journal entry, fixed asset provision depreciation to revaluation. Revaluation by fixed assets. Amount is 2 lakh by provision for depreciation. It is 1,20,000. So there is profit to the extent of 3,20,000. So it will be transferred to capital account. To profit on revaluation, transfer to capital account. Transfer to capital accounts. Both are equal partner, X and Y. So it is 1,60,000, 1,60,000. So total comes to 3,20,000. Then revaluation account is closed. So journal entry is revaluation account debited. Third journal entry, revaluation account debited. That is, amount is 3,20,000 to X capital account 1,60,000. Then to Y's capital account 1,60,000. Being profit on revaluation transfer to capital account of partner. Being profit on revaluation transfer to capital account of partner. Then we will calculate the adjusted capital of partners. Adjusted capital of partners. in the new firm. Partners Y and Z in the new firm. So we have to calculate the net assets. This is fixed assets. It was 12 lakh. It is enhanced to 14 lakh. So we write fixed assets at cost. Fixed assets at cost. That is 14 lakhs. Then add current asset stock. Add current assets. Stock 6 lakhs. Then debtors 4 lakh. Then bank balance to be, it is clearly given, we have to leave only 50,000 at cash at bank. So bank balance should be 50,000. This is the total assets, that is 10 lakh 50,000. So total asset comes to 24 lakh 50,000. So liabilities, creditors 2 lakh less liabilities, creditors 2 lakhs. So adjusted capital is 22 lakh 50,000. And this adjusted capital 22 lakh 50,000 will be given by Y and Z. Here it is given Z is getting 1/3 share on admission. On admission, Z is getting 1/3 share. So Z share 1/3. So Y will get 1 minus 1/3, that is 2/3. So that profit sharing ratio is Y is to Z is equal to 2:1. So Y is closing capital or capital at the beginning of admission of partner, that is Y is closing capital should be, or adjusted capital, closing or adjusted capital should be 2/3 into 22 lakh 50,000. So it is 15 lakhs. 15 lakhs. And Z's adjusted capital. This is adjusted capital, you can write at the end of the. That is as on 1st April. This is 7 lakh 50,000. So this is the closing capital of Y and Z. Then here goodwill is 3 lakh. It is to be written off. When the goodwill is written off, actually for this goodwill, we will see how much X is getting. X is retiring, he wants his share of goodwill, so we will debit Y's account. Y's account debited 1,50,000 to X capital account. Y's capital to X capital account. This is 1,50,000 being goodwill written off. Being goodwill written off. Now we will calculate how much capital will be, or how much cash to be brought by partner Y. So Y will bring, so Y's capital, Y's adjusted capital, that means we have to keep this much capital at the end. On 1st April, it is 15 lakhs. Less capital before admission of Z. Capital of Y before admission of Z. So it is 10,20,000. 10,20,000 plus share of profit on revaluation. Share of profit on revaluation 1,60,000. So total comes to 11,80,000. Less goodwill to the extent of goodwill adjusted or adjustment of goodwill adjusted to the extent of 2 lakh. Extent of 2 lakhs. So 2 lakh here. Wise capital debited 50,000, here wise capital debited 1,50,000, so total 2 lakh. So 9,80,000. So cash to be brought in by Y. Cash to be brought in by Y. This is how much? 5,20,000. Y will bring 5,20,000. So we will prepare one capital account. Capital account of 3 partners. That is 2 partners capital account, another will take its amount. So capital accounts as on opening date, on admission date of partner. So this is so this is left hand side debit side, this is right hand side credit side. So XYZ, then this is particulars, this is particulars. So first we will see the opening balance of X and Y. So Y balance brought down. Opening balance X was 10,40,000 and Y was 10,20,000. Then revaluation profits. By revaluation profits 1,60,000, 1,60,000. Then goodwill retain of X account debited, Y account debited to goodwill. So goodwill retain of goodwill. This is 50,000, then 50,000. Here the goodwill is adjusted. Y account debited to X 1,50,000. Y debited to X capital account. It is 1,50,000. Then Y to X, X credited by Y's capital account. By Y's capital account, it is 1,50,000. So closing balance we already calculated of existing Y and Z. So 2 balance carried down. Amount is Y is 15 lakh, then here 7,50,000. So by bank, Z will bring 7,50,000 and Y will bring 5,20,000. 5,20,000. So total 10 plus 1, 11,80,000 plus 5, 11, 5, 16, 17. So 17. It is 17 closed. Correct. Then Z 7,50,000, 7,50,000. Then we will calculate for X. X credit is 10,40,000 plus 1,60,000, that is 12 lakh plus 150, that is 13,50,000. 13,50,000. 13,50 minus 50. So two bank accounts. That means X will take how much? That is 13 lakh. That is 13 lakh. So another, so journal entry will be bank account debited. Here, suppose the journal entry is bank account debited to X capital account. Sorry, to bank account debited to Y's capital account. Amount is 5,20,000. Then to Z's capital account, that is 7,50,000. 7,50,000. So total comes to 12,70,000. 12,70,000. So we will prepare the cash at bank account. Cash at bank account. So as per the question, the opening balance was 80,000. So write opening balance cash at bank as on, that is 1st April 23. Opening balance 80,000. So write to balance brought down 80,000. Then bank account debited to Y's capital account. Y will bring 5,20,000. Then to Z's capital account, Z will bring 7,50,000. Then by X will be paid 13 lakhs. So closing balance is, as per the question, closing balance is 50,000. So it is 13,50,000. Both side tallies. So another journal entry is that we have to write. So we will make two journal entries. One is bank account debited 5 plus 7, 12,70,000 to Y's capital account, 5,20,000 to Z's capital account, 7,50,000, being cash paid by existing partner Y and Z in order to make the arrangement for payment of the retiring partner due. Then we will write X account debited, X capital account debited, that is full settlement, 13 lakhs to bank account. These are the journal entries. 13 lakhs. Now prepare the balance sheets. So balance sheet will prepare. Balance sheet on the opening debts. Balance sheet of newly constituted firm. Of Messrs. Y and Z as on 1st April 2023. So we prepare one balance sheet. This is but in Companies Act 2013, the balance sheet is in vertical form. Here we are preparing some traditional form. So this is liabilities. This is amount. Assets. Amount. So first liability, we'll write capital accounts. Capital accounts. So already we have calculated adjusted capital. So Y and Z. Y is 15 lakh and Z's share is 7 lakh 50,000. So total capital comes to, that is 22 lakh 50,000. Then creditors 2 lakhs. This is a liability side. So total comes to 24 lakh 50,000. Then asset side, first fixed assets valued at 14 lakhs. So we write fixed assets at cost. lakhs. Then current assets. Under current assets first comes stock 6 lakhs, debtors 4 lakhs, then cash at bank or bank balance, cash at bank. This is requirement is 50,000. So 10 lakh 50,000. So total comes to 24 lakh 50,000. Thank you for watching the video. Don't forget to like and share the video to all of your friends so that everybody will be benefited, and don't hesitate to subscribe if already not subscribed.